So what the heck is a PE ratio anyway? Well, mathematically speaking, I feel like I've been blessed that when I see a fraction, I see a ratio, I see anything in mathematics, I love it. It's how my mind works. But I know that a lot of people are not wired that way. As soon as you see a fraction or anything, you pucker up and you think, oh my goodness, this is math. I hate math, right? But it doesn't have to be that complicated. Again, it's only really a simple fraction. So what a PE ratio is, it's a very general way, very general, of trying to decide whether a company is overvalued or undervalued, or whether the stock market's overvalued or undervalued. So what it is the price per share of a stock divided by the earnings per share. And it's important that you have the per shares because they wash each other out in the numerator in the top as well as the denominator in the bottom. Price per share divided by earnings per share. And the idea is that if the price per share of a stock gets really high relative to the amount of earnings or annual profit, some might argue it's overvalued. The stock prices run up and maybe we shouldn't buy it or maybe we should sell it. Conversely, if the price is relatively low compared to the annual earnings or annual profit, when I say low, understand the price should always be more than the annual earnings, right? If the price is equal to the annual earnings, it means essentially, or any company, you could buy the stock and after a year get all your money back in profits and you still own the stock. So the price has to be a multiple of earnings in any company that's at all healthy, okay? But let's say it's a lower ratio. The price is a little lower relative to the amount of earnings. Then some might say, well, it's undervalued. The price is low, it's cheap, I want to buy the stock because there's a lot of earnings and the price will go up. And you have to be careful with that. That's a really, really oversimplification of interpreting price versus earnings and its usefulness. But still, I think it's important you understand it because it's really the most basic financial ratio in the stock market that you could think of. So let's say that you want to buy an ice cream parlor and I'm selling you an ice cream parlor. And my ice cream parlor makes $100,000 a year of profits. And you think, oh, okay, he's making $100,000 a year. I can buy this as like a retirement business or for whatever reason, and I can make $100,000 a year. But let's say that I'm asking $3 million for this ice cream parlor. What's the PE ratio, the price divided by earnings of that ice cream parlor? Well, as you see on the screen, it's 30. 3 million divided by 100,000, right? Simple math, do it on a hand calculator, no reason to be afraid, right? And you have to ask yourself, would I pay $3 million if that were only making 100,000 a year? Well, one way to look at it is if you can't make any material improvements to the business, you'd have to own the business for 33 years, not factoring in taxes, 33 years just to get 3 million of profits out of it to get your money back, okay? So, in order to pay that kind of multiple, a ratio of 30, you'd have to feel like there's some improvements that this business can make, okay? You can make some improvements, you can increase the profits, it might make sense. But now let's say instead I came to you and said, I want to sell this business for 500,000. It makes 100,000 a year, I want to sell it to you for 500. You might think, wow, that's a return. First of all, it's a PE ratio of what? Well, as you see on your screen, it's a PE ratio of 5. 500,000 divided by 100,000. And in that case, this is one case where, many would say lower is better because now if it's that same business at a ratio of 5, then essentially I'm earning 20% a year. I invest $500,000, I get 100,000 back a year. That's a pretty good return on investment, right? In fact, the neat thing about a PE ratio is if you flip it upside down, so it's earnings or profits divided by the price, it's really just a percentage. It's the percentage the company earns. So in the first example, where we had asking $3 million for this little ice cream parlor, you flip it upside down, you're only earning 3.3% a year. Not a great return on investment for something that has risk, right? But when you flip the second one upside down, 100,000 divided by 500,000, now your return is 20% per year. Okay? And that's another way to look at PE ratios to make it simple. But please, please, please don't go out tomorrow and say, I'm going to find all these stocks that have low PE ratios and I'm going to buy them. That is not the right answer because sometimes things have a low PE ratio because they're at the end of they're in the mature phase of their business cycle and the stock price is going to have a slow slide to zero. The reality is stock analysis needs to be done in much more depth than just looking at a simple PE ratio. However, a PE ratio is certainly something, is a good starting point. For example, you can take that PE ratio and compare it to the industry PE ratio and say, okay, if I'm buying a bank stock, let's look at all the average of the bank stocks. What are the PE ratios? And what is the PE ratio of this particular bank stock I'm looking at? If it's more, if it's higher, why is it higher? And if it's lower, why is it lower? Okay, so it's really, truly just a starting point. And to close, when I say a starting point, what I mean is that, for example, our stock analysts, when they're going to pick a stock, they'll look at the PE ratio in the first minute they look at it. But ultimately, it's probably, if one person were doing all the work, it's probably a week of research later before a decision, or more sometimes, before a decision could really be made if that's a stock you want to buy or not. PE ratios, just a starting point.